Okay, so I feel like I still have a learning over it. The only intensity is exactly. And it's really only and then I took a shower. And that's a great choice. You can see them so they're all public knowledge. Yes. Throughout Europe. It seemed like two people. Yeah. You sound like one of his genius. No, they use that spray. I got a job and it's fine. I
didn't know you.
No way.
Okay, folks, I'm going to get started. I know next week is spring break and you probably have big plans for the spring break. I hope finishing your evaluation is one of those plans. So, just a prod in case you haven't started, because once you come back, like only a week before you turn, the end of that week, you come back is when you turn in your DCF, and 2 days after that is the second quiz. So things start to pile up. So just a prod. Today, I'm going to try to complete our discussion of stories and numbers, and I'm actually going to value companies fully. If you notice, I haven't valued a single company all the way through in class, done in the valuation of the week. But I want to talk about valuing companies fully. And in fact, tomorrow's valuation of the week, in case you feel inclined to do it, is going to be my Tesla valuation, because it's a fascinating company. Whatever you think about it, it's fascinating in terms of stories and numbers, how stories can drive numbers and how stories can change and they can break and they can. So it's a perfect example of a company to work with. So today, as I said, we're going to talk about the specifics of valuation and actually value companies. But let's do some starting analysis. As you start to value companies, and you value a company and you come up with a number. Yes?
It's really sharp.
Let's see if that's because something else is on. Let me turn it down a little bit. Maybe that'll help. Is that better?
Yeah.
Okay. So maybe the sound is set too high. So let's say you finish valuing a company. You come up with the value for the company and you have the stock price out there, right? And the value is different from the price. So I'm going to ask you a question about what you conclude next. Is it that you're right and the market is wrong? That could be one, right? It'd be you're wrong and the market is right. Now, but leave open the possibility that you're going to be there, right? Because the first time you value a company, the second time, it's probably better to start with the assumption that you're wrong and the market is right. In which case, what are you going to do? You're going to revisit your numbers. And I'm going to leave quotes around the word revisit your numbers. You're going to revisit your growth rate, revisit your discount rate, and you won't stop revisiting the numbers till what happens? The value matches the price. Let it go. Don't fight it, because it's exactly what you do when you start with that presumption. Is it possible you're both wrong? Absolutely. In which case you're screwed, right? Not necessarily, as long as you're less wrong than the other side and you're wrong in the right direction. You definitely can't be both right? Because there's only one number out there. But this is something you will face up to once you finish your valuation. So think about it. It's a little early. Some of you have already turned your valuations. I've returned them all. I've about 7 or 8. So if you send them now, you'll get almost instantaneous feedback. Within 15 or 30 minutes, you'll get the valuation back, because it's really, I'm doing it on touch, which is I'm not pushing you on the number being wrong. It's about internal consistency. Here's my second question. Let's say you decide to value a high growth company, and some of you are valuing high growth companies. You've discounted the cash flow, and let's say you've decided to do cash flows to equity, which is an unusual choice. It's not a choice I'm pushing you towards, but let's say you discount cash flows to equity back at the cost of equity, and you come up with an equity value of 100 million. The number of shares outstanding is 10 million. But in your cash flows, you're estimating negative cash flows in future years, and you expect to issue 2.5 million more shares. We'll talk about the process of doing that. So you've done a DCF value of your company with negative cash flows in there. You've got the present value of 100 million. You got 10 million actual shares, but 2.5 million more shares you will have to issue in future years. My question is purely a mechanical one. To get my value per share, do I divide by the actual shares outstanding, the 10 million, by the 12.5 million that includes future share count? Or is the answer somewhere in the middle? What do you think? Atul, you want to try? Do you divide by actual shares, fully diluted number of shares?
So I think it's the A is the answer because the negative.
Let me play devil's advocate. I'm an equity research analyst, but we're going to issue more shares. Why aren't you counting it in?
Cash was already taken.
Because the negative cash flows already incorporate the effect of dilution. If you do intrinsic value right, this is a huge pain that you've removed from yourself, right? Because to estimate the 2.5 million additional shares in future years, what did I have to do? How do I know how many shares I'm going to issue? I have to take my negative cash flows, estimate what share price I will issue them, and you can already see the circular logic you're going to be trapped in. If you do intrinsic value right, your negative cash flows are already incorporated in the present value because your present value is lower because of those negative cash flows. That is the dilution effect already built in. And it's tough to get across. Actually work with numbers so you can see the effect play out. So we'll come back and talk. When we talk about young companies, you're going to see this play out. So now I want to go back to storytelling, and especially those of you working on your valuations now, you're wrestling with this question of storytelling. Last session, I talked about the first step in the process, learning enough about the business that you can tell a story. And the second step was you stopped and made sure the story passed the 3P test. Is it possible? Is it plausible? Is it probable? And I took my Uber story, and maybe I was too light on myself, but I think I passed all 3 tests. I can give you a basis for my story. Urban car service company, already doing it. Pulling new people in. The Bay Area, they've doubled the size of the car market. They pulled it off. With local networking benefits, even by 2014, you could see this process evolving. You didn't have hundreds of ride-sharing companies. You saw very quickly that you were consolidating. Keep doing what they're doing. So they're already doing it, nothing to justify. And I did mention that I could have told a bigger story. What's the advantage of telling a bigger story? You get a bigger number, right? As a founder, you're torn between the urge to tell a really big story because you get a really high price, or telling a more compact story. And your first urge is, let me tell the biggest story I can. I'll get the highest number I can. But there's a problem that follows, right? You collect the number. You've told this really big story. First, you got to justify the story. So far more defense to play. And then once you've told the big story and got my capital, what do you have to do? You have to deliver on that story. You've made your business a much more difficult business to run because you promised people things that might be out of your reach. So you tell the story, you make sure it passes the 3P test. And here I'm going to give you a note of caution, especially if you're an investor. Once in a while, you will run into a story that you so want to be true that you don't even ask questions. I'll tell you the components of the story. The storyteller is this incredibly charismatic person you really like, usually the founder. Second, they're telling a story about disrupting a business you've never, ever liked. And I can name quite a few. Okay? And third, this is the icing on the cake. While they're disrupting the business, they're going to make the world a better place. Come on, don't you want the story to be true? Let me tell you a story, and you tell me whether you want the story to be true. It's about a 19-year-old who drops out of Stanford. Who does that? You know how difficult it is to get in? Gets in and drops out, to start a business. You're saying another tech geek starting another software business. Here's where the story takes an interesting turn. It's not another 19-year-old male dropping out to start a software business. It's a 19-year-old female dropping out of Stanford to start a blood testing business. Now, come on, do you guys like the blood testing business? In the US, if you think about the experience, it's the exact opposite of a good experience, right? Here's how it'll begin. You will call Quest Labs to make an appointment. We have an opening 6 months from now. No, I could be dead by then. Something sooner, 6 a.m., 6 weeks from now. You take it. What choice do you have? You show up at 6 a.m., they make you wait. Why? Because they can't. 2 hours later, the door opens and the nurse comes out. She looks like Nurse Ratched from One Flew Over the Cuckoo's Nest. Say, come on in. Knees knocking, you walk in. There are 2 buckets next to it. So what are those for? Your blood. Why? Just in case Dracula shows up. How much of my blood do you need? They extract half your blood. Anemic, you crawl out of the place. You go back to your car, you drive home, you don't hear from the place for like 4 weeks. So you call them and say, I want the results of my blood test. We can't give them to you. Why? Privacy. It's my blood test. We've given them to your doctor. Talk to your doctor. You call your doctor, you go through this process again. 6 months from now, 6 weeks from now, 6 a.m., show up, wait 2 hours, you walk in. Your doctor's obviously got your blood test. He's looking very troubled while he looks at the blood test. So you wait, and after about 10 or 15 minutes of terrifying you, he says there's nothing wrong with you. You leave. Don't heave a sigh of relief yet, because the ultimate indignity is in the mail 2 weeks later, right? What do you get? A bill from Quest Labs saying your insurance did not cover 7 of your 15 blood tests and it'll cost you $1,500. Come on. Don't you want this business to be disrupted? Everybody did. So here's what the 19-year-olds come up with. She's going to take 2 drops of your blood, not 2 buckets, in a nanotainer. This already sounds very 21st century. Buckets are so 15th century. And in 45 minutes, she's going to run 32 different tests on your blood, some of which you don't even know what the test is, but it's another test. The whole thing is going to cost you $50, and she's going to email you the results. It's almost like she's caught up with time. And along the way, you know, what she's going to do, she's going to give away this blood test for free to parts of the world where people can't afford blood tests, and all the lives you can save. Come on, don't you want, if you were making a Hollywood movie, this would be such an uplifting movie. This is, of course, not a made-up story. This is the true story of Elizabeth Holmes and Theranos. Did people get excited? Boy, did people get excited. By the middle of 2015, venture capitalists were pricing the company, use the word value, should be pricing the company at $9 billion. And some of the biggest names in venture capital were on the list. Ted Draper was on the list. $9 billion. Venture capitalists get excited really quickly. True. The Cleveland Clinic was touting Theranos as the next big thing in blood testing, one of the leading health entities. And Walgreens was planning to add a Theranos lab into every Walgreens. You can see collectively. Now, if you'd asked me in the middle of 2015 what I thought about Theranos, my answer would have been, I don't know much about the company, but given the $9 billion and Cleveland Clinic and Walgreens, there must be something there. I assume that somebody somewhere along the way would have asked the question. If you have a blood testing company, what's a big question you want asked and answered before you throw money in? Does your blood test work, right? This is not some fuzzy thing. I assume somebody would have asked the question, but I was wrong. Nobody seemed to have asked the question, because in October of 2015, a Wall Street Journal reporter decides to ask the question, and the answers were actually in the public domain, because you have to file with the FDA and get approved. He went to the FDA and said, Theranos on its webpage is claiming that this test works on 30. Now, how many of these 32 tests have they been approved for? The FDA said they were approved for 1. And he said, what about the other 31? And the FDA said the results are a little noisy. You're saying, what's a noisy blood test? Trust me, you don't want to see one. Comes back and says, you might be dying, or you might not. Don't worry about it. Blood test, you want precision, right? Now, roughly, you might have a lot of blood sugar or you might not. We can't really tell. You could be in a diabetic coma before the whole thing gets resolved. In the next 6 months, the entire company unraveled. The 9 billion became zero. Elizabeth Holmes, by the time you get to 6 months out, has been banned from the blood testing business for 3 years. And there were criminal cases already accumulating across her, which ultimately got the final sentence came down last year. She actually moved to San Diego. You used to keep running into her in the, when you went for a walk. I mean, I don't know what she was doing. Maybe she thought it was a foreign country. She wouldn't be extradited, but it turned out to be part of the US. She's now in jail. I don't know what the sentence is. But when it happened, I remember people saying, how can you not ask this question? So I wrote a post then, which you can still read, where it says that it's easy in hindsight to say, why wouldn't I have asked the question? But I remember when Elizabeth Holmes came to New York in the middle of 2015 to give a celebrity talk. There were like 1,000 people in the audience. People had brought their daughters along so they could see 29-year-old first, a billionaire starts a business, essentially. I said, if you'd been at that meeting in New York, you're surrounded by people who brought their 6-year-old, 8-year-old daughters, would you have had the courage to get up and ask the question, does your blood test work? You'd have felt like the guy who shot Bambi's mother. I've always felt for that guy, the hunter at the start of the movie. Bambi's mother falls over. I mean, you were killing dreams, basically, right there. It's easy in hindsight to say, how come nobody asked the question? You're caught up in the moment and everybody else is kind of caught up in that this is the most amazing thing ever. It's really difficult to ask the question. That's why I use the Emperor's New Clothes as kind of the perfect way to think about why people don't ask these questions till it's too late. The process worked out again with WeWork. When WeWork came out, same process. I remember looking at WeWork's IPO. And their basic business model is what? Leasing out buildings for 30 or 40 years, often in the most expensive parts of the city, and then subleasing them for 3 months, 3 weeks, 6 weeks. It's never worked in real estate before, right? Why not? What's the problem with that model? You got a duration mismatch made in hell. You're one recession away from going under because you have a recession, everybody leaves, you still have the lease payments. And I remember reading the 400-page prospectus. What gave WeWork its heft? Goldman Sachs estimated that it should go for 95 billion. So how do you come up with the 95 billion? What was it that made WeWork so attractive to investors when it went public? Who was the biggest investor in WeWork? SoftBank, and by extension, Masa Son. And Masa Son in 2019 was viewed as a visionary genius. You know what the last round that SoftBank invested in WeWork at was? 47 billion. Here's how Goldman Sachs's mind works. Masa Son priced WeWork at 47 billion. He's a really smart guy. He must have got a deal. Let's double it. They must have made a mistake in 2 times 47. Yeah. Come up roughly 95 billion, and you reverse engineer the whole thing. If you get a chance, go back and look at the WeWork prospectus. It's still on my webpage because when it came out, I tried to value it. 412 pages. I was convinced when I started reading it that they must have found some secret sauce to deal with the duration mismatch. I mean, it's staring you in the face most of it. 412 pages later, no mention of a duration mismatch. And the whole thing looked like it was either in denial, you were not, or that they just were assuming you didn't care. The case of WeWork, the whole thing kind of spun out to go back in the other direction, right? What did WeWork do on its prospect around the IPO that you think caused the whole thing to unravel? Because two months later, if you remember, the IPO was pulled from the market. And the only reason it ended up at the number is somebody came in and said, we'll pay at least 8 billion. You know who that somebody was? SoftBank. Why? Because they want to write it down to zero. This is a business you look at and say, how can you ever think that this is a good idea? The only problem is the arrogance that WeWork showed at the time of the prospectus. You read that prospectus, and it was jaw-dropping in terms of some of the clauses you read. In a normal company, in a publicly traded company, when a CEO is incapacitated, what's the process you go through? The board of directors gets together, they look at candidates, they pick one, right? You know, the WeWork prospectus said would happen if Adam Newman was incapacitated? That Rebecca Newman, his wife, would pick a successor. What is this? The French royal family? But the fact that they thought they could get this through tells you how arrogant they were in terms of thinking, we're special. I mean, what was Adam Newman's pedigree for starting WeWork? How did he become famous? Does anybody know? He gave a TEDx talk in 2012 about the importance of we, community. And it's strange when one of the most narcissistic people on the face of the earth uses the word we, but that's often the context in which we work. That became WeWorks. He took that TEDx talk and he made it into this company that then he got Master Son to buy in. And that's how, when you look at runaway stories, they melt down. Usually the narrator has feet of clay, new discovery. In the weeks after the WeWork filing, the New York Times reported about the strange behavior that Adam Newman had around headquarters. He insisted that people not wear shoes. You know, basically walked around bare feet, and other people had to walk around bare feet. And he said, this is not what rational people do. And eventually that once you start to question the storyteller, then everything else starts to spin out of control because there's nothing else here beside the story. Yes.
We also think about Tesla as a.
You could argue that there is but have you ever driven a Tesla? There is it a fairly unique car? Is it I mean, we got to give Musk the credit. He took a business that there had never been a competitor in a century, right? Look at every person who tried to enter the automobile business in the 20th century. Read the story of DeLorean or watch the documentary, right? Every person who tried to disrupt this business, what happened? They crashed into their assembly line wall of not being able to invest. So I remember when Elon Musk started Tesla, you know what the rest of the legacy auto companies said about his chances? They laughed. They said, how will a startup electric car company ever change the way we do business? 16 years later, what's every legacy auto company trying to do? Become an electric car company. So this is not Adam Newman, right? There is, and think the same thing with SpaceX. Why, what's the reason SpaceX has been able to expand as much as it does? It costs them half as much to get a satellite out in the sky than any competitor out there. I mean, there are people trying. I mean, that's the reason SpaceX has taken off. So clearly there is substance here. Has he, is he got that narrator aspect? Absolutely. The problem is he keeps spinning tales that essentially take Tesla. It's not just an electric car company. Yes, when I posted my Tesla valuation, you're guaranteed to hear from both sides. And the people said, what about Optimus? You know what they're talking about, right? The robot business. And this is constantly the issue with Tesla. You say, look, as an electric car company, it's not worth $1 trillion. They said, that's not it. It's automated driving. They seem to have moved on from automated driving. Now it's robots. And you got to give Musk credit in terms of he's able to build a story out there, get enough people believing in that story. And that might be one thing that's been missing for the last 14 months. He's not been telling stories about Tesla. He's been telling stories about other things. And people are saying, when will you come back and tell me another story? We need a story now, a story that goes beyond robots. So, there is a component of that narrator aspect that people invest in the company because they believed in him. So I think that's
why maybe it's not be overvalued, but there is a.
Could be, yeah. In fact, I put a number on it, right? I put 150 on it because, and I like Tesla and I like Elon Musk. As a visionary, I think you need people like that to change businesses. So it actually, when I got the 150, I wished it had been 350, right? Because in a sense, I bought the stock last year when it went to 170. But I want it in my portfolio because it is a company that's changing the automotive business. It's changed it already. It's not changing. It has changed it. In fact, if you ask me 50 years from now, what will be the three automobile companies standing? I think Tesla and BYD will be two of the three. The third might be one of the legacy auto companies. I don't know which one. It's not even a question of can Daimler become, no, Daimler is never going to be the leading electric car company. BMW, I will be willing to bet that no legacy auto company will be in the top two globally. You know why? Because when you buy an electric car, you're not buying a car, you're buying an electronic device. Think of it as a very expensive smartphone with a big battery that you can drive around. Then ask yourself a question. Would you buy a smartphone made by, I don't know, RCA? Now, just putting the name on it, you say, hey, they can't make this. They're all 20. You see already, if I make a Daimler electric car versus some, Lucid electric car, I'm already saying Daimler, they're so 20th century. They make cars. I want an electronic device. And I think that's what the legacy auto companies were missing is they thought their brand name that they developed from the automobile business would travel into the electric car business, and it's not doing it. But if you have visionary spin out, it usually starts with the narrator kind of spinning off. And that's your worry with Tesla is your lead storyteller is now become a political hot rod, right? It's never good for a company where half the market will not buy you because of your politics. I don't care which side of the divide you're on. And then you realize the story is at war with the numbers, that the person's been telling a story. And with Theranos, that was obvious because the numbers there basically was it doesn't work. And then you have a bad business model on top of it. The whole thing blows up. So when you tell stories, but be careful about how far those stories will take you. Take a little tangent here and talk about big markets. What's the current big market? What's the dream that people are holding out? AI, right? Is this the first big market? No, in my lifetime, I've seen big markets come and go. Some have been fleeting. But China, 25 years ago, big market. Social media, 15 years ago, big market. PCs, 40 years ago, big market. So let's say you're looking at a big market and you're an entrepreneur. And you want to start a business to be part of that big market, right? Could be the India story or AI. Pick whichever big market you're more comfortable with. Now, I want to step back and ask you something about, in general, about entrepreneurs. Do entrepreneurs tend to be overconfident people or diffident people? What do you think? It's almost by definition to start a business. Actuaries are very, very poor entrepreneurs because they work through the odds and say, you know what, the odds are against me. So to begin with, you're an overconfident person looking at a big business. So you think you could conquer it. You go out and seek money from venture capitalists. Julian, venture capitalists, overconfident people or diffident people? They always think they can pick the winners, right? What does that tell you about them? I am special. I know who the winners are. So you've got an overconfident entrepreneur who attracts overconfident VCs. You have a cluster, right? And you're looking at a big market. What does that mean when I say you're overconfident? That you overestimate your chances of succeeding, overestimating revenues. And there are 100 other clusters just like yours all over Silicon Valley or wherever your tech is. Each of them thinks they're special. Each is overconfident. And each values their business based on that overconfidence. Let's play this through. So if I take business by business and take the valuation that are going to emerge from every business, or the pricing if you want it, and I add the numbers up, what is the collection of my numbers, the aggregation of my numbers going to look like? It's going to be too high, right? Eventually, the truth comes out. Reality is an ugly beast. It rears its head. And there's a recognition that we can't all succeed. So what do you have? You have a correction. And then people wag their fingers and say, this is what's wrong with you guys. This is why we'll never do it again. You've heard that before? We'll never do that again. It's a feature, not a bug of big markets. And trust me, you will do it again, and I want you to do it again. Sounds like a strange thing. So I wrote a piece saying, what's so bad about bubbles? You know the amount of backlash I got on that one? What do you mean, what's wrong with bubbles? Bubbles burst? But do they change the way we live? That .com boom and bust? Yeah, it changed the way we live. The social media boom and bust changed the way we live. AI, there will be a boom and there will be a bust. It'll change the way we live. In fact, the question I asked is, I ended that post saying, would you want to live in a world run by actuaries? I don't want to keep picking on actuaries, but think of actuaries as everything being driven by probabilities and expectation. We'd still be in chaos. This fire thing is that, you know what, it's not been fully tested yet. One of these days we'll get out there. Thank God we don't live in a world run by actuaries. Or the flip side of this is, if you want change, if you want creation, you got to live with chaos. I still remember the regulator of the Singapore stock market. You know, I was in Singapore a couple of years ago. He said, "Can I come over and talk to you? I have some, you know, I have a question to ask you." And he comes over and he says, "We want to make Singapore's equity markets more exciting, track more." And I said, well, I can tell you how, but you got to be willing to live with a little chaos. You know what Singapore thinks about chaos, right? The Singapore market will not ever be the hub for exciting entrepreneurial growth because that always comes with chaos and disturbance. It's a part of the noise. So I call this the big market delusion. Right? If you have a big market, and I use the online advertising business about 10 years to illustrate how this plays out. I took the online advertising business, I took publicly traded companies, companies like Google and Facebook, got almost all of their revenues from online advertising. I took their market caps and I backed out from the market cap what the revenues would have to be 10 years from now to break even. So I used the solver function in Excel to solve for that. Then I added up all of the advertising revenues. I got 10 years out for each of the companies. And I came up with a total that was 50% larger than the overall advertising market, all advertising put together. Can't happen. But you can see how this gets built up because even if you think about how equity research analysts value companies, they value the company. But you can see the same phenomenon in a lesser way play out there, right? They picked a company, they think it's going to be the winner, they build the numbers, but there are 50 other analysts picking 50 other companies working their way through. Big market delusion, it's part. One final example, and then we'll leave this alone. So this is about 10 years, 11 years into talking about Tesla, might as well go back to Tesla. This is Tesla very early in its life. As around the time I did my first valuation of Tesla, where I valued it as a luxury automobile business, because that's where I thought it was going. So I did my valuation, and Tesla's always had the good or the bad fortune of being followed by equity research analysts who are not analysts in the traditional sense, they're Tesla advocates. So this is a valuation done by one of the biggest names out there in terms of equity research tracking Tesla. I won't name the person, but you could probably trace him back if you want. So he puts out an equity research report around the same time that I value Tesla, and his value is 6 times higher than mine. And I'm curious. So I open up his report, keep looking for why his number is so much higher. I look at his projections for revenues. Tesla was selling 24,000 cars then, and he projected that it would sell 1.1 million in 15 years. Plausible? We give you a rough sense. Last year, there were 80 million plus cars sold. So 1 million is clearly within the range of what you think somebody's success. So I said, okay. In fact, his estimated number of cars was actually a little lower than mine. Then I said, maybe he's assuming software company margins. So I look at the margins. His EBITDA margin was actually a little lower than mine. Now I'm completely befuddled. He's projecting out less cars sold than I am. He's projecting slightly lower margins. How is his value 6 times higher? So I went and looked at his unlevered free cash flow, which is free cash flow to the firm. I prefer the free cash flow to the firm. And he also had what he called net income, which is really like he had an after-tax operating income.
When you have after-tax operating income and free cash flow in a spreadsheet and you add them up, you basically get two numbers. The difference in the two numbers is what you're reinvesting, right? So I took the next 15 years of after-tax operating income in a table, the next 15 years of free cash flow in a table, and I looked at the difference. And there was almost none. In fact, collectively over the next 15 years, he was reinvesting almost nothing. We have a problem. You know what the problem is? In 2013, Tesla had one factory in Fremont with a capacity on a really good day to make 250,000 cars. You're selling 1.1 million cars. There's a gap here, right? I called the analyst. He was in an airport on his way to California, maybe to worship at a Tesla shrine. I don't know what he was going to do. And I said, look, I want to talk about some of the numbers in your equity research report. And he said, I can't talk about them. I said, why not? He said, well, I don't actually work on the numbers. I have a team that works on the numbers. I said, you had a team turn out this DCF? Yeah, it's a team of 6. I said, okay, can I call you next week? He said, yeah, we'll all be together. And then he says, you're not going to write about this on your blog or anything, right? I said, not for the moment, but after next week, all bets are off. So I called the guy, the entire team is gathered together. So lead analyst comes on and said, so I said, what do you do? He says, he describes, basically he schmoozes. He talks to people, different industry people, company people, chief schmoozer. So I said, what about your second in command? He says, I'm the secondary schmoozer. I go with this guy and the third guy's a backup schmoozer. One of the two guys, I said, who in this group does something other than just schmooze? They point to this 24-year-old kid they hired out of Wharton 2 years. He's the guy. Nice way to throw somebody under the bus. So I lead him through. The kid's pretty smart. He gets it very quickly. Basically that, I said, what happened? He said, it slipped my mind. I said, what slipped your mind? He said, I took the CapEx and depreciation of the most recent year. In the most recent year, Tesla had not built much factories. I just projected them out. And effectively, I built in close to zero reinvestment over time. And I said, do you think you have a problem? He said, yeah, of course, we can't make 1.1 million cars when your capacity is 250,000, but there's no easy way for us to let the market know that we screwed up. We can't go back and say, it slipped my mind. He said, do you have any suggestions? I said, I do, and you might not like them. I said, have you ever watched this movie, Willy Wonka's Chocolate Factory? He said, no, but one of the older analysts had. You seen that movie with Gene Wilder in it? One of my favorite movies of all time. I still remember watching that movie when I was a much, much younger person and coming out of the movie with a singular question. There's only one factory that Willy Wonka had. It's a very badly engineered factory with like chocolate rivers running through it. And I remember asking the question, how does that one factory produce all these chocolates that Willy Wonka sells around the globe? The answer is actually in the movie. These little munchkins called Oompa Loompas. You go onto Google and type in Oompa Loompa. And as they dance, chocolates come flying out of the factory. So I said, here's what you need to do. Put out a news release that Tesla has fired all of its Fremont workers and replaced them with Oompa Loompas. The problem's gone. I call these Oompa Loompa valuation. You build in big growth, no reinvestment. Unless you have Oompa Loompas, this is not going to fill itself. So the next time you pick up a DCF, I want you to put it through the test, right? Take it through because it's right there in front of you. You have the tools to take it apart. So now let me talk about converting stories to numbers. In the case of Uber, if you remember, my story was of an urban car service company that will attract new people into the business, right? So where do I start my story? By estimating how big the urban car service market is. You know how much of a nightmare this was to estimate in 2013? Who dominated this business before Uber came along? Taxi cab companies around, and they're all privately owned. So here's what I had to do to get the size. There was no number out there. I went through city by city. New York City has a taxi and limousine commission. They can tell you how much taxi cabs collectively generated as revenues last year. I did this for New York, I did it for Tokyo, I did it for London. I got to about my 50th city, and I was really tired. By then I was at 50 billion. You know what I did? I doubled it. And I said, I'm too tired to go beyond 50 cities. The total size of the urban car service market is 100 billion. To show you how you should never trust Google search. 6 months later, I get on and say, maybe somebody has a good estimate. Said, size of the urban car service market on Google. Guess what pops up as the number one find? Damodaran estimates it at 100 billion. See, do you guys know what Damodaran did to estimate it? I won't take you into the kitchen, but this wasn't some specific estimate based on special information. But I had to start somewhere, 100 billion in total revenues. That market had been growing at about 2%. It was a really slow growth market. But what was the second part of my story? To attract new people into the business, right? So instead of using 2%, I use 6%. Who is it drawing in? People like my son and my niece who would never take a taxi cab come into the business. Third, if you remember, I said Uber has local networking benefits. And you probably said, who cares? In my story, what can happen? You can have 10 ride-sharing companies around the world dominating different parts. What does that mean? Your market share is not going to be 40, 50%. It's going to be closer to 10%. So I gave them a 10% market share, even as a successful company. What do they do? Connect drivers with customers. That's a low-cost business. You're an intermediary. I gave them a 40% margin. And to grow, what does Uber have to do? Close to nothing. I still remember the way they added Delhi to their list of cities. They hired one guy, put him in a hotel room. They didn't want to pay for an office. And he went around signing up drivers to sign for Uber. Cost them almost nothing to grow. The way it shows up is I gave them $5 of revenues for every dollar of capital, a huge amount of revenue. That's twice the average for a typical service company in the US. And finally, were they a risky company in 2000? Big money losing company. You know how I computed the cost of capital? By doing none of the things we went through 5 sessions doing. Bottom-up beta, cost of debt ratio. Instead, I went to my histogram of cost of capital for companies, and I went to the 90th percentile. When you're valuing young companies, this is not the place you want to be spending immense amount of time. Estimating a debt ratio, doing a bottom. It's going to do absolutely nothing for you, and it's going to shift over time. I gave them a high cost of capital. And is there a chance they could just still fail, at least looking at their numbers? Yeah, they're a company with $1.5 billion in losses, hasn't figured out how to make money. If the venture capital stops, they're done. The only thing they have going for them is they're too big to fail for a venture capitalist. You see what I mean by that? You've written it up to 17 billion. The last thing you want to do is write it down to zero. So there's going to be greater temptation for venture capitalists to bring in more capital just to keep them going. So I gave them a 10% failure rate. My story has become numbers. The valuation kind of flows right out of it. Because once I put revenue growth, margins, reinvestment, cost of capital, think of my Ginzu spreadsheet. I've got the numbers. The valuation comes out. Looks like a spreadsheet, but every number in this spreadsheet reflects my story, right? If you ask me, why are my revenues 3.6 billion in year 10? It's because Uber is an urban car service company with local networking benefits. Why are my margins 40%? Because they're an intermediary. Why are they reinvesting so little? Because they don't own the cars. Every number there, if you point it and say, why is that number what it is? My answer is going to be some part of my story. Adil?
What's the share of market number?
Well, I have the 10%, I have the 3.6%. So basically all you do is go from 3.6 to 10, right? The end numbers basically are the numbers that matter. So if you disagree with me on year 2, I'm going to give you year 2. You want year 3, you can take that too. You give me year 10, I control this narrative. So the value that I got was 6 billion. It was June 8th. The Wall Street Journal article that I told you triggered me on this came out on June 3rd. So at the end of the week, I put this up. It's like 3:15 in the afternoon, Friday afternoon. 10 minutes later, maybe 15 minutes later, I get a call from a Wall Street Journal reporter. She must have just been waiting at her desk for this post to come through. She said, I noticed you valued Uber. I said, thank you for noticing. She said, I also noticed you attached a value of 6 billion. I said, you're very observant. She said, you do know that venture capitalists have valued the company at 17 billion. I almost corrected her. You know what the correction would have been? They price companies, don't value them. But she's a journalist. I cut her some slack. I said, yeah. She said, how do you explain the 17 billion? I said, I didn't pay it. I don't have to. I have never felt the urge to explain what other people pay. You know how much frustration this has saved me in my life? Because it's amazing how much time people spend trying to explain what other people do. What business is it of yours? They're overpaying? Let them overpay. This finger wagging that goes on of this is crazy, this is shallow, it doesn't do anything for you. And they're going to do whatever they want. She said, are you telling me they're wrong? I said, I'm telling you nothing of the sort. I'm saying I have a story, a value that comes from the story, and an action that comes from that value. Maybe they have a bigger story. You need to talk to them. The way I think about valuation is I have my valuation, my numbers, my action. You know, after I put the Tesla valuation up, I get a bunch of emails saying, you know, why are you encouraging people to sell short on Tesla? Did I say anything about other people? I said, look, I take, you know, this is what's going to drive my decision. The architecture for you to disagree with what I've done is right there. So you think Tesla is going to make money on Optimus? Add a fourth line item, create a revenue and see if you can get up to 500, 600, 800, whatever you want. But the essence of a story is essentially it gives you a number that drives your actions. And finally, talked about keeping the feedback loop open. So in the case of Uber, I was very fortunate because after I put this post up on June 8th, over the weekend, I get calls from 4 different places. The first was a site called 538.com. You heard of 538? Nate Silver used to be pollster for the New York Times. So it's a statistics geek site. It was owned by ABC. They just shut it down, in fact, a couple of weeks ago. But at that time, it was a thriving, standalone site. And they said, can we run your post? Because a lot of our readers are numbers people and will appeal. I said, be my guest. And took the entire post valuation ran there. The second place I heard from was the Forbes blog. Who reads the Forbes blog? I think 75-year-olds with flip phones. It's a really old-time value investing crowd. They take the same post, same valuation, run it through. The third place I got called was TechCrunch. What is TechCrunch? It's a digital magazine which caters to Silicon Valley. It's read by software people, VCs. They said, hey, we'd like to run this because many of our people are interested. And I said, go ahead, same post, same valuation. And the final place it ran was a site called the Ride Sharing Guy. I think it's still around. It was run by a guy called Harry Campbell, who wrote for Uber and Lyft drivers, prime audience. There are millions of those. And he said, can I run this? Our Uber drivers would be very interested. I said, go ahead. Same post. So Monday morning, all 4 sites run it. And I start hearing from people in all 4. So in the 538.com site, here's the kind of question I get. I noticed you used a 12% cost of capital. But in your histogram, because I'd also put the histogram into my post, at the 90th percentile, the cost of capital was 11.97%. Why did you use 12%? So I leave my spreadsheets open. I said, why don't you go into the spreadsheet, change the 12% cost of capital 11.97% and see what happens. 5 minutes later, I get a very sheepish response saying nothing happened. I could see why you did what you did. Nothing much learned from second decimal point questioning. But that's what numbers people essentially go to. On the Forbes blog, they absolutely loved it. They patted me on the back. They said, this is how tech people should value companies. Zero useful feedback. I skipped over very quickly. Then I went to the TechCrunch site. These guys absolutely hated it. Their response is, how dare you value one of ours with your D.C.F? We don't do that in Silicon Valley. So you get this bunch of responses. Half of them were pure insults, some of which I didn't even quite get. One said, you DCF guy. That was the entire insult. You're saying that, is that a good thing? Is that a bad thing? I don't know, right? It wasn't meant as a compliment, I think, but I couldn't read the subtext. The other half started with an insult. You idiot. Let me tell you how surge pricing works at Uber. And you know what? I learned if I got past the insult. I'm not a tech person. I don't know what the infrastructure is that allows a ride-sharing company to get an advantage. And I learned some very interesting things about the technological components. But I had to get past the insult. And then I heard from people on the ride-sharing, and I learned things about Uber that I would never have learned talking to the top management. A driver in LA wrote to me and says, I'm an Uber driver in LA. I used to drive for Lyft until 3 months ago. Uber paid me $3,000 to switch. Now Lyft is offering me $5,000 to switch back. I feel like a free agent without a contract. And this is how he ended. He said, I wouldn't be surprised if all of this money they're spending, they end up with more than 7 or 8%, not the 20% they claim to investors. 5 years later, Uber leaks that their contribution margin in big cities is 7 to 8%. I almost wrote to them saying, a Uber driver in LA told me that 5 years ago. But this whole process for me came to fruition about 3 or 4 weeks after I finished this post. I'm sitting in Munich airport waiting for a connecting flight, and it's delayed. I start checking my email, and there is an email from a guy called Bill Gurley. Heard of Bill? Partner at Benchmark Capital. Benchmark Capital was one of the first VCs to invest in Uber. They invested $1 billion pricing. Bill was on the board of directors of Uber, rumored to be the person closest to Travis Kalanick. Those of you who watched was it Netflix that had the Uber thing? He's a lead character in it, so there's somebody playing Bill, obviously. But let me ask you an easy question. Does Bill Gurley know more about Uber than I do? Absolutely. So I opened the email, and here's how it begins. I read your post on Uber, and I did not like it. Glad we got that out of the way. I've written my own post to counter your post, blog post to blog post warfare, very 21st century. And he said, I've said some mean things about you. I just wanted to let you know. Sincerely, Bill. I close the email. I have an hour and a half left my flight. Guess where I go? I go to Bill's blog. It's called Above the Crowd. The guy's 6 feet 6 inches, so it's above the crowd. And here's the lead article. It's still on Google. You can find it. Never goes away. It says, Damodaran misses by a mile. Get it? Uber misses by a mile. My GPS is not working. I got the subtext there. And then he took issue with every part of my story. He said, Uber is not a car service company. It's a logistics company. Notice how words have consequences? By using the word logistics, he's already expanded businesses, car service, moving, delivery. He said, it's not just urban, it's going to be everywhere. He gave examples of suburban and rural services. And finally, he said, it's going to take cities like New York and London, where it's already dominant. And here's what we're going to do. We're going to connect with credit card companies and airlines. So if you make a reservation to fly from New York to Jakarta on United, right below your reservation, there'll be a box that says, do you want an Uber car waiting for you when you get there? A very clever way of taking local networking benefits and making them global networking benefits. I was fascinated. Along the way, he said some mean things about me, but I have a thick skin. He said, this Damodaran has never taken an Uber. It was a lie. I've taken one Uber. Right? But one is more than zero. But basically, I finished the post, and then I write to him and I say, I'm still sitting in Munich airport. I say, you've told a big story for Uber. Would you like me to put a number on your story? He said, what are you talking about? I said, these are old stories. I can make it. He said, be my guest. So here's what I did. I took my valuation of Uber and changed two things. Remember the total market, 100 billion for urban? I made it 300 billion. Moving and delivery triples the market. Remember the 10% market share, local networking benefits? If he's right, there'll be only 2 or 3 ride-sharing companies dominating the world. I gave Uber a 40% market share. You take those numbers, the value you get is 53 billion. I sent this to Bill and I said, do you like this more? He said, a lot. And he said, oh, by the way, that 20% share is probably going to slip away. And I almost told him the Uber driver in LA told me this already. But that was an input in my spreadsheet. I changed the 20 to 10 and came up with a value of 29 billion. You see, how can the same company be worth 6 billion, 29, and 53? Well, depends on how the story is framed. Doesn't mean they're all right. Doesn't mean they're all plausible, but you can see how differences can play out. So over the rest of the year, I hear from people saying, I don't like your total market. I don't like your market share. I don't like this. Finally, I said, look, this is my story, my value, my decision. But let's make it your story. Have you ever been in a Build-A-Bear store in a mall? They're freaky little places. Basically, here's how they work. You go in, especially if you have a 6-year-old, 8-year-old, you walk in, and they give you a piece of skin. And over the next 30 minutes, your 6-year-old will make one of the ugliest bears, And then they do this very sneaky thing. They will come up to you and say, you don't have to buy that bear, but if you do, it'll cost you $75. I guarantee you're not leaving that store with your 6-year-old without that bear. So I stole from that idea and made a build your own valuation of Uber. So at every stage, I let people pick their own story. Is it Uber? Is it a mobility, a logistics, a car service? So essentially you pick your business, you pick whether you have local, global or no networking benefits. And at the end of the process, I came up with valuations reflecting the story choices. You see that last column? What does that tell you? People who read this post say, this is why there's no point in doing DCF. You can justify any number. That's not the way I see it. In young companies, when you disagree on value, it's not because your growth rate is different from mine. It's because you're telling a different story. And I'm going to probe, what's your story? Why? Because I want to steal some of your story, if it makes sense, and bring it into my story. So as you look at these numbers, they reflect different stories and different values. Not all of them are equally plausible. So you've told a story, you've got the inputs, you got a value, you say, okay, I'm done. Can your story break? What happened to Chegg? Chegg is a homework company, took off, had a $2 billion market cap just a couple of years ago, now down to close to zero. Why? What does Chegg do? You're a ninth grader stuck on an algebra problem. You call Chegg, there's somebody who helps you through, charge you. It's like an Uber for people, for students. I mean, the Uberization of the world is now complete. Everything is you're an intermediary. It became a $2 billion value. Why did the value collapse? What broke them? Have you tried asking ChatGPT you could get a hypothesis. If all you're getting is very basic descriptions of what needs to be done, hey, you know what? AI can do that. You don't have to pay somebody. You don't need an intermediary. That's the first company we've seen break, that AI completely break. There will be others along the way. So that's a story break. And with young pharma companies, this could be a test, a stage in the process, a blockbuster drug, where basically it doesn't work, you pull it off. Story breaks. That's the most extreme. Stories can sometimes shift, which means your basic story stays the same, but you add a new market, you increase your growth a little, margins might improve. I've been telling the same story for Apple for the last 15 years. It's a smartphone company which has been the greatest cash machine in history. I still tell the same story, but you add a little service business here, so it's a shift with it. Or stories can sometimes change when a company does something you did not expect it to. But a new business actually opens up. Microsoft's story shifted dramatically when the cloud business took roots and took off. Until then, the story I was telling was of a two-hit wonder that couldn't figure out a way to come up with a new product. Stories can break, which is bad news if you like stability, right? There are people who believe that intrinsic value, once you get it, it's timeless. Already you can see stories can change, stories can shift, and your value could shift. And what can cause stories to change? Well, obviously, it can be earnings reports, but it can be something completely unrelated numbers. Okay? I'll give you an example, and this will finish my Uber story. My biggest change in my Uber story happened about a year and a half after I wrote this post. I went back home to visit my mother, who lives in Chennai, which is part of India, which is incredibly conservative in terms of, it's about 20 years behind everything else happening in the country. So 75-year-old conservative South Indian woman. So I get home and she says, let's go somewhere. And she names a destination. I don't even know where it is. And I say, okay. She says, I'm going to call the car. And I'm expecting her to do the 75-year-old South Indian woman, which is open the window, driver, bring out the car. Instead, she starts hitting a smartphone. First, I'm surprised she has a smartphone. I say, Mom, what are you doing? She says, I'm calling for a car, an Uber. I said, you use Uber? She says, all the time. I said, I can't come with you. I've got to go back and revalue the company. You see why? That 2 to 6% increase that I got, what did I assume? That people like my son, 20 would be coming in. You've got a 75-year-old woman who's never taken a taxi cab in her life, wouldn't even dream of doing it. Kind of changed my entire perspective on what the potential market would be. There's a tipping point for your stories. That was my tipping point, right? So when you think about stories, everything is feedback, right? When you buy a Tesla and you're walking, and you bought Tesla, the stock, and you're walking down the street and you see somebody keying a Tesla, you should feel the urge to go back and say, I have to revalue the company. This is something I did not have in my story. So stories can change, and I think that's makes them fun because it means you're not just driven by the numbers, you're constantly looking for feedback. That's why I said Tesla is going to be this experiment where you can see your story shift on a day-to-day, hour-by-hour basis. Makes it terrifying if you want stability. If you wanted stability, you wouldn't be looking at Tesla in the first place. So now let's talk about valuing companies. Okay? I'm going to show you a bunch of valuations, and to save myself some time in terms of numbers that will show up, in every one of these companies, because they're spread out over time, you're going to see an equity risk premium. So I'm going to give you some perspective on where that number comes from. Before 1998, and there might be one company I'm showing you where the value comes from before 1998, I used to use a 5.5% premium for mature markets and not change it very much. Between 1998 and September 2008, I used an implied risk premium, but it's pretty stable around 4%. You're going to see a lot of 4%. Then, of course, you have the 2008 crisis, and the whole thing blows apart. And I started doing premiums on a monthly basis. Any valuation you see post 2008, you're going to see the implied equity risk premium as of that month. So I'm using exactly the same process still, but the numbers obviously will shift over time. And with each of these companies that I'm going to value, I'm going to go through that structure of here's the company. I'll know some of these companies, if you're not familiar, I'll tell you what they do. I'll frame my story, and then you're going to see the valuation. Now, you're going to be bored stiff if I go through every line item and every valuation. So in each valuation, I'm going to focus on what I think is interesting and different about that valuation. So let's start easy. Let's talk about stocks that look like bonds. What does that mean? They pay a big dividend, they're low growth. This is the Ben Graham kind of stock, right? This is the stock that, So the company I'm going to pick to value is Con Ed. What does Con Ed do? All these lights are on right now because Con Ed's supplying the power, right? It is a regulated monopoly, and already my story is getting frayed. If I just stopped with monopoly, what do you get? Pricing power. You could talk about but this is a regulated monopoly. Regulated in what sense? It's regulated in terms of what it can do. Con Ed can't go buy AI stuff or invest in software. The nature of its business, it's got to supply power. It can do whatever helps you supply that power. Where's the regulation? It's given the monopoly, but to set prices, it has to go in front of a regulatory commission. The commission tells them whether they can raise rates or they have to keep. And what does the commission base it on? Whether you can raise rates. You're thinking too rationally. They will look at inflation, but this isn't the rental commission, right? They look at the returns you make as a company. And this is actually one of the first places where the CAPM actually became a tangible number, because you could come up with a cost of equity and you'd hire experts to tell you what it is. Let's say it's 8%. You make a 12% return equity. You go in front of the regulatory commission and say, like a price hike. The commission says, looks like you're making too much money already. So come back to us when you're, so it becomes, so you can already see that this is a very constrained valuation. And regulated utilities are the mothers of all dividend payers. They pay dividends like essentially because investors who invest in them want dividends. They're older, they need the income. So already you can see the story being framed. It's a regulated monopoly serving a state where the demand for power is not going to go up 10, 15%. Might be different if you're in a mountain state, or maybe a Florida. Or here you're talking about slow growth, paying a big dividend, and already you can see where I'm going. When you pay a big dividend, the question you always have to ask is, are you paying too much? Are you paying the right amount? How do you check that? You estimate the potential dividend, the free cash flow equity. And here's the first thing. I looked at how much they paid in dividends. They paid 73% of their earnings. Already you can see this is not going to be a high growth company. And if you looked at their free cash flow equity, it's very close to dividends. So I'm going to be okay using the dividend discount model in terms of not overvaluing, undervaluing the company. So it looks like a mature company in terms of how much cash it returns. I did stop and see what kind of growth do they have. And remember, this is a company very much in steady state. The retention ratio is 27%. The return on equity is 7.7%. And their expected growth, if you take the product of those, is 2.1%. Is it a growth they can sustain forever? Well, it's well below the risk-free rate. So I feel pretty comfortable assuming. So it's a big dividend-paying company, mature growth. There's one final stop I wanted to make. I didn't want to lock in a cost of equity that'd be incompatible with a mature company. Mature companies should have cost of equity pretty close to the market average. As a regulated monopoly, it's probably going to be lower because you got a guaranteed market in the pricing. So I gave them a beta of 0.8 and a cost of equity. Notice the return equity is roughly equal to the cost of equity. And it's almost by regulation. They're going to see that pressure to keep going. So I've got a mature, stable growth dividend paying company. How do you value a mature, stable growth dividend? You use the oldest of all discounted cash flow models, a Gordon growth model, a dividend discount model. I took the expected dividends next year, which is 232, this year's dividends growing at 2.1%, and divided by the cost of equity minus the growth rate. And I can see some of you saying, I should have picked Con Ed to value for my project. You'd be done in like 5 minutes, right? The value per share that I got was $42.30, and the stock was trading at $40.76, slightly undervalued. Remember at the start of the class, I said, what do you do when the value that you get is different from the price? One question you can ask is, what is the market assuming that might be different from what I'm assuming? In this case, the market might be assuming slightly lower growth, right? Is there a way I can solve for it? Absolutely. And that's basically what we're going to do next. But before we do that, there's one extension that I want to point you to when you do a discounted cash flow valuation that might help you. When you do a discounted cash flow valuation of a company, no matter which model you use, the value per share you get is as of today. You compare to the price today. The reason I'm emphasizing it, most equity research reports, if you look at them, don't tell you the value today. They give you a target price 1 year from now. Is there a way you can take your value per share today, in the case of Con Ed, which is 42.30, and make it into a target price a year from now? And I'm going to give you some ammunition. You have a cost of equity. I can tell you how much dividends they pay. What do you do, Jacob?
Why the growth rate a second time on the top.
So take 42.30, grow it at 7.7%. That's the total number. But then that would be your price if there were no dividends, right? Remember, you get that 7. Subtract the dividend from that, you're going to get an expected price of like $44.30. You're a sell-side equity research analyst, you put that as a target price, $44.31. I don't show them what you did because they said that's all it took. Make it sound like you did some mysterious analysis. The stock is actually trading at 40.76. One way to think about an undervalued stock is if you buy it at 40.76 and it goes to where you said it was going to go, you're going to make, instead of 7.7%, 12%, 13%, 14%. You're earning more than your cost of equity. You can take your DCF value, make it target price 1 year from now. Could you do target prices 2 years from now? Yeah, see, you can repeat this process. You can try to blow the daylights out and give me target price for the next 10 years. It's just an extension. And if you buy a stock if you tell me a stock is fairly valued, and people sometimes miss this, you're actually saying the stock will go up next year. Fairly valued doesn't mean the stock is going to stay flat. It is going to go up at the cost of equity. And if you have a money-losing company or a non-dividend paying company, that can be a pretty substantial increase on a year-to-year basis. So any questions on converting DCF value into a target price? Yes, Ashima?
Taking cost of equity as the growth rate.
I'm sorry?
Why are we
It's
taking-
not, because if something is fairly valued, that's what you can expect to earn on it. That's a definition of the cost of equity. So it's not that you're using it as a growth rate, but if I want to earn a 7.7% return and I pay 42.30, I'm going to take the 42.30 and grow it. But the reason I'm taking dividends out is my total return will take price appreciation as well as dividends. So once the stock is fairly valued, that's what you can expect to earn as a return on that stock.
Capture risk again, right? We've done that when we did.
42.30, it's already there. It's risk is also in the expected return. Riskier stocks, you should expect to see more price appreciation, but it's coming from the higher risk. Second company I'm going to value is 3M. What does 3M do? Lots of boring things that make a lot of money. I always marvel at those Post-it notes. There should be a special corner in the Nobel Prize winners, or the guy who invented Post-it notes. It's a commercial genius, right? You know how much money 3M makes on Post-it notes? You can get them in different colors, different sizes, little tabs. And they've just expanded the idea. So this was a valuation I did on September 12th of 2008. The Friday. The Friday before a weekend where Lehman announced they were in trouble and they were looking at this was the Friday before the crisis started. And the reason I'm going to do this valuation is to show what happens to value of a company, but none of the numbers might change, but a week later, you're looking at a very different marketplace. So I did my first valuation and I didn't see the crisis coming. I'll be quite honest. It was Friday morning. I wanted to value 3M. Why? I have no idea. I told a very boring story, a story of a company that doesn't reinvest much, reinvest only 30%, but has a great return on invested capital. That pattern on the post-it note keeps competition out. That gives you a growth rate of 7.5%, not over the top, but this is a mature company, 7.5% growth. And at the end of year 5, I put them into stable growth with a growth rate of 3%. So this is a very standard, easy valuation, a two-stage valuation where I'm using sustainable growth. And I'm assuming I live in a nice developed market where bad things don't happen overnight. I came up with a value per share of 83.55. Stock was trading at 70. So ask me the question. You know, the question you have to ask is to figure out whether I actually believe my own valuation. Did I buy? I wanted to, but I was too lazy. I said, do it on Monday morning. Best decision ever. Procrastination actually paid out because on Monday morning, what did we wake up to? A crisis of historic proportions. 6 weeks later, I decided to revisit the 3M valuation. No new earnings reports had come out. The numbers were exactly the same. But the world I was valuing the company in had shifted under me, right? So what had happened in those 6 weeks? First, markets had collapsed. And the second is the economy looked like it might be rolling into a recession. So same company, same base year numbers. Nothing is changing the base year. Here are the changes I made. First, notice my risk premiums for both my debt. The rating didn't change, but the default spread for that rating increased. And the equity risk premium, if you remember that graph of what happened in 2008, the equity risk premium had been 4%, it jumped to 6%. You hold everything else constant, already you're going to see a knockdown in value from that. I did get a little more conservative about my estimated growth rate because you're heading into a recession, you're not going to be able to deliver the same kind of returns, slightly lower growth, higher cost of capital. I did bring in the lower T-bond rate. That's one of the few benefits you get is that the T-bond rate dropped. The value per share that I got was $61, down from 84. Am I surprised it dropped by that much? Not after a crisis like this one. The stock price was actually 57. This time, I did buy the shares. Still in my portfolio. It's gone through ups and downs. It's got lawsuits hanging over it. It's got all kinds of things that have gone through. But my point is you can value a company. When is your project due? May 5th, which is like a lifetime away in the markets we're living in now, right? Who knows what the market will look like on May 3rd? Hopefully you will not have a 2008 crisis between now and May 3rd, but if it does happen, you know exactly what to do. Don't throw up your hands. The biggest number that's going to shift is the equity risk premium. I will update my implied equity risk premium on May 1st. And if it's really a crisis, I'll start updating every day. If you want to make it a direct input off my webpage, you're welcome to. So your equity risk premium gets updated on its own. It is the device that you use to capture market crisis. The price of risk goes up, the value of everything will go down. Let's talk about third value. At the start of 2022, or actually somewhere in the middle of 2020, I don't know exactly when, September of 2022. Remember, inflation had become this bogeyman, markets were starting. So I decided I wanted to value the S&P 500 because the market had been down during 2022. And I wanted to say, did it drop enough? Did it reflect? So how do you value stocks? You take the expected cash flows, you get a risk-adjusted discount rate. You can think of the entire index like a stock, right? This was actually a very first valuation of the week where you take the entire index, you estimate the cash flows. So I'm going to set you up on the questions I had in September of 2022. And then I'm going to ask a little bit about where we are today and think about the questions you would need to ask today to value the index. One of my first questions is, when I was projecting cash flows for the index, I was using analyst estimates of earnings. And one of the, at least in September 2022, there was talk of a recession around the corner. And the question is, do my earnings numbers reflect that recession? I can't answer it right now, but that's one of the questions. Second, if you look at the cash that S&P 500 companies have returned historically, it was a very high percentage of earnings. But part of that came from feeling secure about the earnings stream and low inflation. My second question is it possible with inflation that companies will return less cash because they feel more uncertain about the future? Right? Third, you have no choice but to take a stand in expected inflation because it's going to play out both in your interest rates and your growth rate. So right now, you know what the interest rates are, but will inflation increase? In September 2022, we had no clear sense whether we're going to double-digit inflation or dropping back to 1-2%. And as expected inflation rises, not only will interest rates rise, but it also will push up the equity. So inflation is the central character, and it always is. When inflation rears its ugly head, it always becomes a central character. So the question is, how do those numbers play out? So when I value the index, I'm basically taking the present value, the expected cash flows, but the numbers are coming from different places, and it's my job to ask those questions to make sure they reflect. So first question was about earnings. I looked at the expected earnings at the start of every year, through 2020, through at the start of every month, and you can see that analysts had actually increased their estimate of expected earnings. There'd been a little pullback in the last few weeks, but analysts did not seem to be worried about a recession. In hindsight, they turned out to be right, and the economists turned out to be wrong, but analysts were not marking down earnings dramatically. And so their expected earnings in 2023, and you can see over time, not much change. What does that tell me? Analysts don't seem to be building an expectation of recession. So if you're valuing the company and you think there's going to be a recession, you have to take their estimates and lower them. Second, I looked at the percentage of earnings that US companies have returned to their investors in the form of dividends and stock buybacks. And if you look at that statistic, it's clearly been all over. The median across the entire period was about 85%, or 80 to 85%. But by the time you got to 2015 or 16, it was as high as 108%. But in 2022, it was back to a normal level, at least based on the history. If this number had been 130%, that's something to worry about as well. Can they maintain this cash returned over time? So I'm kind of framing the valuation. Here's what the final valuation in September 2022 looked like. I took the analyst estimates and I assumed that they were underestimating earnings by about 15%. So I pushed in that 15% drop. Collectively, the companies had returned 90.5%, but I assumed that going forward, they'd become a little more careful, that they would return only about 80% of their earnings. You're saying, how do you know? I don't. I'm making my best judgment. I did leave the T-bond rate at about 4%, saying the bulk of the inflation effect has already played out. It's in my T-bond rate. And the equity risk premium I used was 5%, the average since 2008, saying that's where we're going to end up. So think of this as status quo valuation of the index. And the value that I got for the index with these pretty onerous assumptions was 35. The index was at 3,600, which is within 4%. And I said, you know what? I know there's lots of talk about the index being in a bubble and correcting. I don't see it because I lowered earnings by 15%, raised the equity risk premium, but I'm pretty much where the market is, at least of September of 2022. Could I be wrong? Yeah, I know where I can screw up. I could be off on the earnings or I can be off on the T-bond rate. So what I did was I took variance of the risk-free rate and earnings to see what the index would look like at every level. See the shaded, the shades don't show up. But any number greater than 3693 would essentially make the index undervalued. Any number less than. So at least in September 2022, the number was about 55% overvalued, 45% undervalued. I don't know whether you remember the valuation of the week from the start of the year. I'd valued the index at the start of 2025. Does anybody remember what my base estimate value was? I think it was 52.20 for the S&P 500. It was at 58.81, making it overvalued by 12.5%. And there I actually ran a Monte Carlo simulation where I took my big assumptions about earnings and growth rates and risk premiums and I simulated multiple values to see what percentage of the time I got values greater than 5881, which is where it was at. And I think at the start of this year, it was like 72% overvalued, 28% undervalued. Now, the index now is around 5550. It's getting closer, but remember, the value itself has also shifted. So I have to revalue the index. I'm not a market timer. I don't act on my market valuation because I really don't see what I bring to the valuation that'd be unique or different. I'm not a Fed watcher. I don't know where rates are going. So I do it just to kind of get a sense of where is the market right now. At the start of the year, it did look, overpriced is the way I would use it, given all the numbers. And that was with base year earnings. We had a recession on top and fears of risk premiums going up. The thing very quickly becomes 15, 20, 25%. So if you get a chance, revisit that valuation, update the numbers. The T-bond rates have clearly shifted since then. Put the equity risk premiums in and see what you get. Because if you listen to the noise around you, part of the reason I wrote that piece that some of you might have read about, globalization and disruption coming to markets, is I was feeling a little unbalanced. Unbalanced in the sense the world I grew up in, and I'm old, and so the world that you definitely grew up in as well, seems to be changing under me, right? For much of my life, this march towards globalization seemed almost inexorable. I think the process kind of took a break in 2008, but clearly we are entering a new phase. And this is not just Trump. And part of the reason I did it is I'm sick and tired of being reactive, right? Every day there's another story. I refused to go on CNBC for the last 2 weeks simply because of that. They're going to ask me about whatever the story of the day is and want my instantaneous reaction. What does this do to the market? I don't know. And it's just, so one of the reasons I would, whenever I'm unbalanced, two things help me. One is to step back and gain perspective. How did we get there? And I think what you're seeing is a playing out of those two large forces we've seen for the last 4 days, 4 years, 4 decades. One is the cresting of globalization, as I call it. I think globalization peaked in 2008. What happened in 2008? Because globalization is essentially experts saying, trust us, we know how to run the world. And 2008 was a reminder that they really didn't know how to run the world. I don't think they've ever regained that trust. So much of what you've seen for the last 17 years, I would think of as a blowback against globalization and all of the things it's enriched. Who's gained from globalization? China clearly has been the biggest winner. Half the growth in much of the last 20 years has come from China, right? And of course, it's not something that they got put in their lab. They worked for it. They built, they made themselves a manufacturing hub. They took the money. They built infrastructure. It happened accidentally. Second big winner from globalization is global institutions, right? I mean, World Bank and IMF have already been with us, but they got empowered by globalization. Then you add the EU, then you got agreements like NAFTA. There's this push towards spreading the power from domestic to global institutions. Third was experts, who seemed to have at least a measure of what the problems of the world were, what the solutions were, and they had forums like Aspen and Davos where they presented this to policymakers. So clearly, and the fourth one is financial markets. Markets have become the arbiters of policy, right? You're a government, you try a policy, the markets don't like it, you walk it back very quickly because, and it's also enriched the cities that are the centers of the market. Let's face it, New York, Tokyo, Frankfurt, this has been a good 4 decades, not in terms of livability, but in terms of the wealth and power that's accumulated. The winners, have there been losers? Let's go down the list. China won, and it's true, global growth is not necessarily a zero-sum game, but I listed the 2 parts of the world that have lost the most. Japan in 1995 was 17% of world GDP. You know what it is now? 4%. Europe was 26% of global GDP. It's now 14%. You say, what about the US? The US was the outlier. It actually increased GDP. We'll talk about why that might be from the disruption perspective. Big loser. Who else is lost because of globalization? So in terms of geographies, manufacturing jobs, especially in Europe. Now you take the number of manufacturing jobs in the US, peaked at 20 million in 1979, it's down to 13 million. It's leveled off because essentially manufacturing hubs. And this might be controversial, but I think democracy has been a casualty of globalization. And here's why. What's the biggest selling point for democracy? Is you don't like the way your government is run, you will elect a different party to run it, right? But there is this perception that it doesn't matter who runs your country, that there are global forces that are going to determine. And I'm not being a conspiracy theorist. That is the perception. And among younger people, the perception is even stronger. You talk to people under the age of 35, the sense of nothing I do is going to change this because it's being set by, and that's insidious. It eats away. And if you look at the Economist measures the extent of democracy around the world, it's been dropping for the last 18 years. Fewer people are under democracies now than at any time in the last 2 decades. And in my view, the biggest problem with globalization, its advocates never talked about the losers. All win, we all win. There's no, of course there are losers. And when they raise their voices, what do you tell them? Learn to code. How insulting is this to ask a 55-year-old factory worker to learn to code? So how is it played out? Well, Brexit and I mean, you're seeing it play out in politics, you're seeing it play out in economics. What I'm trying to say is Trump and tariffs are not, they're just a symptom of a much bigger move against globalization. It's not going to end here. I mean, we're approaching a decade where you're going to see more domestic. Will it mean we'll go back to the way we were in 1979? No, not at all. That ship has sailed. But I have a feeling that many of the things we're used to with globalization, we're going to have to get less used to because it's kind of coming from this process. So if you get a chance, read it, because I also talk about disruption and how it's come to government and whether it can succeed. I mean, let's face it, the leaders there come from South America, Javier Milei in Argentina, Nayib Bukele in El Salvador. Can you bring that to the US? That's what basically DOGE is trying to do. It's an extraordinarily dangerous project, but it's disruption coming to government. So if you get a chance, read it, because the Tesla valuation is towards the end of it. Yes, go ahead.
Hey, how are you?